Hello, everyone. Welcome to our new webinar. We're starting on the dot, so let's kick off right away. This is a webinar to give you an update on the Climate Tech Portfolio Fund 2 that we've been raising for 6 months now. There's been quite some progress, some new funds in there. So what we'd love to do is give you an overview of the fund, revisit a bit what the fund is. We'll give you an update on what investments we've done and fundraising and traction so far. And we'll also revisit a little bit what's behind this specific fund. So we'll talk about how we see the opportunity space and also give you a view on how we're currently looking at the macroeconomic situation and what that means for whether this is a good time to start investing in climate private equity. What we won't be doing is covering the full climate investing stack or what other things we need to do to get to net zero next to investing. Those will leave for other webinars. So here we're really focusing on the Climate Tech Portfolio Fund 2. We also won't be talking about the other funds that are currently live on our platform, but you can go to the website to check those out. In terms of a few pointers for this webinar, so we would kindly ask you to use the Q&A section if you have any questions, and you can pop them in there anytime you want. We'll try to answer them whenever is most appropriate. So either it's during the session or right at the end where we have reserved some time for your questions. Some of you are already sending questions beforehand, and those we'll discuss during the webinar whenever they suit best. And next to that, there's a chat function, which you can choose to send messages either to the whole group or private messages to us if there's something you want to share. And we also really welcome you to send an intro of who you are and what your role is in the chat in case you want to introduce yourselves to the other participants. In terms of the agenda, there's quite a lot of ground to cover. We'd love to start with, again, briefly, what is climate tech and why would you be interested in investing in it? Then we'll cover to why invest now in climate tech. So what is the current market looking like? And is this a good time to get in? From there, we'll talk about the portfolio fund and really how we thought about constructing it and the different parts that go into it. Then we'll talk about how we select funds, what our due diligence process looks like. We'll talk about the 2 first funds that we've selected and the pipeline of what funds we're currently looking at and expect to be coming up. And finally, we'll get to the final Q&A. So I'm not doing this webinar alone. Right now, you just see me, but the other 2 people joining me is Wiebe Visser. He's our managing director. He spent 5 years at JP Morgan and then a decade at Alpinvest. So he's really our fund selection veteran. And we'll also take you through how we're looking at the opportunity in the market. And then Carolina, she joined us as employee number 1 after having spent some time at Venture IQ doing a lot of venture scouting and analyses on the market before joining Carbon Equity. Carbon Equity in a nutshell, just very briefly. So what we do is we offer low minimum ticket access to the best climate VC and PE funds. And the idea is that with a smaller investment, you can access a highly diversified set of really exciting climate tech companies. The fact that we made a fund-of-fund is to make sure you get maximum diversification. So with a single ticket, you invest in 7 to 10 funds, meaning at least 150 companies. And we really pride ourselves on doing very strong curation. So we spend a lot of time looking at every single one of those funds, making sure we know all the funds that are out there and picking the very best ones on both financial and impact considerations. Finally, we try to keep our costs really low. I would say lower than many other fund of funds in the market, because we just think that it should be a really fair product with an attractive return. And we do a lot around community building. So far there's been 500 investors that invested onto the platform. And we do regular events also so that people can meet each other. On to why invest in climate tech and what is it to begin with? So one doom and gloom picture, and I promise we'll keep it to one, but the globe is heating up. If we don't do anything, we'll get to 4 degrees. Fortunately, there's been a bunch of policies already implemented. And the IPCC calculated that taking all implemented policies together will limit global warming to 3.2 degrees. Fortunately, on top of that, there's a lot of private action and intended policies. If you add all of those up, we get to 2.4 degrees. But for the Paris Agreement, we need to stay well below 2 degrees. Why well below? So I think the most important thing to understand about climate change, and probably many of you do already, it's not about that average warming, right? Because 1.5 or 2.5 average increase in temperature is not a disaster, definitely not in Northern Europe. But where it gets really bad is that with that average increase, we get more and more extreme weather events. And so on the right-hand side, what you see is the annual hottest day temperature change. And there you see that if the world heats up 4 degrees, the average hottest day will be 8 degrees hotter. So that means that a day that today is 32 degrees becomes 40 degrees. And that's where you start to see that it gets really painful. And next to those more extreme heat, we get more extreme, any kind of weather really. And that's what we're trying to avoid. So how we're going to do that? We're going to decarbonize 5 industries and then build a whole carbon industry next to that. And together that spans actually most of the economy. So when we look at the share of emissions, it's the middle row you see there. See that energy is actually responsible for most emissions today. That's mostly because of electricity production from gas and coal. But there's also a lot of emissions involved with pumping oil out of the ground and refining it. So all of that we're trying to get rid of. In industry, we're talking about any kind of material creation, be that clothes or steel or concrete or plastics. So a lot of innovation happening there to get it to net zero. I'm switching back and forth from the biggest to the smallest. So now we're going to food and agri, which is our number 3. There's all around the food we produce and how we consume it and how much of it we waste. And as most of you probably know, eating animals is the biggest emitter in that, but there's many other things we can do. Mobility is about how we move around, crowd transportation, flights, but also how we move stuff around. So think shipping. In buildings, it's mostly how we live. So how we heat, how we cool, how we cook. And then finally, on the right-hand side, there's the carbon market, and that's all around carbon capture, carbon removal, and carbon usage. Right now, it's still quite a small industry, but that needs to get really big to get to net zero. And we also really expect it will. So how are we going to transform all of this with climate tech? So climate tech is defined as any kind of innovation that's explicitly focused on reducing GHG emissions. And a lot of different types of climate tech exist. So there's a lot of hardware, a lot of stuff that we need to change. An example here from our portfolio is Sunfire, and they make the machines to make hydrogen with and sell those machines. There's also a lot of software involved. On the right-hand side, you see Normative. It's a really advanced carbon accounting platform that 2150 invested into. And actually, quite a lot of climate technologies are a combination of hardware and software. So there's some hardware in there, there's some software in there, and together that all works. And a great example is Amped Energy. It's a company that produces batteries for construction sites. So rather than putting on generators that consume a lot of diesel, you put one of these units there. And so there's a lot of batteries involved in the thing, but also a lot of software to make sure that it charges and discharges really efficiently and you have power throughout the day. The thing with climate tech is that well, the great thing is that we really know kind of what set of technologies we need to get to net zero. So in the vertical axis on this chart, you see the reduction in emissions from 0 to 100%. And so we know how to get to 100%, and there's a very specific list of technologies behind that. And the less great news is that not all of those technologies are mature today. So what does it mean? If a technology is mature, that means that it's widely available, it's really advanced in its development trajectory, and it's at cost or cheaper than the alternative. And it's been incredible to see that solar and wind are now both cheaper in 90% of the world than any kind of fossil fuel power. And you can buy a solar panel pretty much anywhere. Early adoption technologies are technologies that you can buy on the market, but maybe not from as many players. And the technology is not at a perfect parity in terms of price and quality. So heat pumps are a great example. You can buy them pretty much anywhere, but they're still rapidly developing. So you can either install a heat pump today or wait 12 to 24 months from now, and it will probably be even better. Demonstrated technologies we know how to produce, but they're not widely available yet. And synthetic aviation fuel is a great example. It's actually been a lot of investment and activity in synthetic aviation fuel. The European Union also just mandated that it will become mandatory by 2030 to mix it into any kind of airplane leaving Europe. So a lot of innovation happening, but we still need to build those big factories to produce it at scale. And finally, research and design. Any kind of technology has really been proven in the lab, but we need to figure out what the best way is to get it to market. And there you can think about carbon negative cements. So a lot of innovation still needs to happen. Universities are working on that, and then startups and scale-ups are incredibly important for pushing these technologies up in their maturity stage and getting them to market. The great news is that we really see so much support for net zero, and with that for all of these companies to get to that scale. Very importantly, we see that governments have widely committed to net zero. By now, 91% of all GDP in the world is covered by some kind of net zero targets. Now, some of those targets are for 2060, or they don't cover everything, so it's not perfect, but we really see that gearing up year after year. And also, very importantly, over the last 18 months, there's been an incredible push from governments in also funding the whole transition, and specifically climate tech. And the IRA is probably the biggest one. The Inflation Reduction Act out of the US is $369 billion formally committed to subsidizing any kind of climate technology. But in practice, there's no cap on this number. And it's quite likely to hit $1 trillion or more in total funding in terms of whatever requests come in. Next to that, we also see corporates actually putting in a lot of effort to get to net zero, or at least increasingly publicly commit to it. So by now, almost half of all European Union corporates have a 1.5 degree climate transition plan, meaning they don't only have the targets, but they also have a trajectory of which products they will change how to make sure that they meet that target. And then there's also a bunch of M&A activity happening by those corporates. And that's actually very important also for our climate tech market, that the majority of all climate technology companies exit to those corporates. So they're putting in a lot of money in place to also get those innovations in that they need to meet those transition plans. Now, consumers are also increasingly really getting ready and committed to net zero. So 2 out of 3 consumers in Europe say that they really care about sustainability. They think about it when they make a purchase. And what I find fascinating is that increasingly people say that they're willing to pay a green premium. So they're willing to pay a little bit more for something that's green or sustainable. By now, 90% of millennials say yes, that they're willing to pay a 10% premium. And finally, the financial sector. There's an insane amount of money being available or being committed to net zero. So by now, 40% of all global private financial assets are part of a net zero alliance. There's still a lot of room for improvement for how that money is actually being invested, but at least the public commitments are in. And we also see that at least some of those big institutions are increasingly investing in climate technology. And what that leads to is a lot of big growth markets. So there's about 100 climate technologies, and we need all of them to get to net zero. I'm just highlighting 4 here, but just to give you a view of how everything is forecasted to grow. So green hydrogen right now is 300 million markets, but that's expected to grow to 10 billion in the next decade. Heat pumps are expected to double, but looking at recent traction and government commitments, especially from the US side, I think that might be more. Meat replacements are also going to grow by at least, 50-fold, 30-fold. So a lot of growth to be had there. And even very mature markets like renewable energy, they're already at 880 billion, can still grow a lot to 2 trillion or beyond. So the opportunity is there. But is this a good time? And I'll hand over to Wiebe to answer that question.
Yes, thank you, Lisa. Good morning, everyone. I think Lisa did a great job explaining why climate technology is really one of the most exciting opportunities for the decade to come. But why is today the right time to invest? So I'll walk you through that, why we think it is a great time to invest. First of all, climate has proven to be fairly resilient. So even in 2022, when the overall market was fairly volatile, disrupted supply chains, increasing inflation, increasing interest rates. Despite all of that, the amount of capital that went into climate increased year over year. So here you see a chart from McKinsey that shows the overall amount of capital invested in private markets into climate. So that includes venture capital, private equity, but also infrastructure. But it increased year over year. And in the past 6 years, it went from 80 billion globally to close to 200 billion. So despite everything that was happening on the globe in the financial markets, you saw that increase. But especially also relatively speaking. So the percentage of the overall private markets that went into climate increased over that period of time from approximately 5% to 12%. So it's not a niche strategy anymore. It's a core building block of the overall private markets. If you compare that to all the other private equity opportunities in private markets, whereas climate increased 6.6%, the others decreased 24%, so way more volatile and susceptible to the overall macroeconomic volatility. So I think that's really a testament to the positive investor sentiment towards climate, and for sure also supported by the regulatory push through the IRA and the European Green Deal. But great momentum. That said, if you look more at venture capital and growth equity investments into climate, there has been a slowdown in the first half of this year, and despite that the number of investments kept increasing. So really the overall amounts went down, the round sizes went down, so a bit more careful deployment, but the number of investments still increasing. So if you break down what caused this, I think overall in the earlier stage, there's still a lot of momentum, and there's still a lot of competition for the great opportunities. It's especially in the later stage and growth equity rounds that you see the biggest drop. And that is really driven by the fact that there were no IPO markets up until a month ago. And people who wanted to invest pre-IPO were just a bit careful. If you can't exit, you don't want to step in. So that was clearly a sign that a lot of capital moved out of growth equity. And ultimately, we need that. We need growth equity to scale these opportunities. So therefore, we're very pleased with at least what we've seen in the last 4 weeks. There's some stability coming in the capital markets. The Fed kept its rates stable, so they didn't increase it for a quarter at least, signaling that there is more stability. And stability is really what people are looking for, especially on the capital markets. And as a result, you saw the first big IPOs of tech companies like Arm listed, Instacart is looking to list. And also very large projects like H2 Green Steel, which is a green steel plant that reduces carbon by 95%, was able to attract $1.5 billion of capital in August. So I think there is good momentum and signs of recovery, and that's very positive. And to add to that, and Liza already mentioned it, the IRA is really a big driver. So just to give you an example of what we've seen in our first portfolio fund, in that portfolio, there are a couple of companies that are a huge beneficiary of the non-dilutive capital that the IRA provides, but also the European Union through its support. So Form Energy, a long storage battery technology, received a huge subsidy to build its first 2 industrial scale plants. Fantastic outcome. Same for electric hydrogen, that is hugely benefiting from a tax credit on hydrogen and is really increasing their deployment of their production capacity, mainly as a result of the IRA tax credits. But it's not only in the US, it's also in Europe. So Sunfire, also an electrolyzer company, received a huge grant to build also 2 plants in Germany to start producing at industrial scale. So very positive push for all these portfolio companies, and some of these might very well end up in the second fund as well through some of the new funds we're looking at. So let me introduce you the Climate Tech Portfolio Fund 2. So how are we benefiting from the huge momentum, and what are we trying to construct and build for you to get access to these exciting technologies? We're raising a 75 million fund, and out of the 75 million, we have already raised close to 60 million. So we're really in the final stretch. And it's great to see so much momentum here. It's a Dutch FGR, so a fund for joint account. It's more from a legal point of view. And ultimately, this fund will commit to 7 to 10 private equity funds across sectors, geographies, and industries, as long as it has a decarbonization focus, clearly. So venture capital growth and potentially some buyout exposure in there. It's as diversified as possible. And from a geographic point of view, it will be a split between Europe and US, probably slightly more US, given that the opportunity set is larger there. But we will have sufficient European exposure in there as well. The fund has a 12 years lifetime for a fund of funds. Most underlying funds are 10-year funds, but we build some flexibility because we have a 1 to 1.5 years investment period ourselves. So it needs to be slightly longer to accommodate the funds in the second year of our investment period. And the fees are ranging from 30 basis points to 85 basis points, depending on the commitment size. We don't charge a performance fee, so no carried interest, but just a 1% setup fee upfront. And important to mention, the target returns. So this is really non-concessionary capital. We expect to make similar returns that you would expect elsewhere in the private markets. So 2 to 2.5 times net return to LPs is what we strive for. And we do that by selecting the best funds out there. In the end, the portfolio will include approximately 150 companies, so it's highly diversified. And the way we do that, we can go to the next slide, indeed, is by selecting multiple funds. And the majority of funds will probably be early stage, let's say Series A, Series B venture capital funds. But we will make sure to have sufficient growth equity and buyout exposure as well, because there the technologies are more proven, and it's more about scaling proven technologies towards commercial scale, or let's say second of a kind plant, third of a kind plant, or rolling out a technology or software solution globally. So there's less risk on the growth equity buyout side, but you also want some exposure to, let's say, the new Teslas of the world at a very early stage. We build in some flexibility to do some co-investments that will reduce the overall fee load. We haven't done any so far. And from a sector point of view, we really want to get exposure to all sectors because we need to decarbonize all sectors. So energy will be a big chunk, industry clearly, but also food and agri, transportation, buildings, and other enablers. Now, why 7 to 10 funds? I think this is important to note. By building a diversified fund of funds, you really reduce the risk of losing capital. If you just pick one fund and you pick unlucky, or you're unlucky and the fund loses capital, that can happen. If you just take all the sample size of private funds historically, the chance of picking a fund that actually loses capital is 24%. But if you add more funds to the mix, the chance of that happening significantly reduces. And this is just by a random selection. If you're able to pick the best funds out of it, it's even lower. So we don't expect a 1.5% chance, but just diversification is your friend from that point of view. So that's why we choose 7 to 10 funds for the portfolio. So how do we select funds? The first, and this is very important, criteria, of course, is the impact. The funds need to focus on decarbonization. So this is also the first step in a process, which we'll describe later on. But overall, decarbonization clearly needs to be the key focus area. That said, there are some funds, for example, in the food and agri space that are focused on a single vertical. They have sometimes a broader definition by also focusing on biodiversity, for example. We find it acceptable as long as overall on a fund level, there's at least, let's say, close to 80% decarbonization focus. The fund structures, we will only invest into closed-end private equity and venture capital funds, so no crowdfunding platforms, no deal-by-deal consortium builders or accelerator programs, and is really non-concessionary capital, so no philanthropy. We really expect market-based returns. We also do not invest in real assets, so no forestry, no oceans, and no infrastructure within this product. We might launch other products in the future, but this fund will not invest in these type of solutions. So the funds we go after could be generalist funds, but also sector specialists, ones that just focus on energy and electricity or food and agri, like I mentioned, but sometimes also funds that only focus on software across industries. We also look at those. And from a stage point of view, we look at the entire spectrum from pre-seed all the way to buyout. So how big is this universe? It's big. So we have identified 400 really climate-specific focused funds. There's a much broader impact fund landscape, thousands of funds, but the ones that are really focused on climate globally are 400. And they range really from global funds to more niche European funds within certain industries, the built environment, food and agri, and tech specialists. So the bottom line is there's a lot to choose from, and we like that. We like the ability to choose from funds. So since the start, we have seen 337 funds that have been raising while we were investing our funds. And out of those, we have done a so-called quick scan. That's our first step. It's a desktop two-pager that we work on, and just to assess whether or not we think it's attractive, and whether or not we want to spend more time on the fund. So it's only 23% of the funds that have been raising that we thought would fit our criteria. And out of those 78, only 33 went into the next stage. And that's a very important stage. That's the impact diligence. And Carolina will explain more what that entails. But there we really make sure that the fund is very focused and intentionally focused on decarbonizing the economy and the planet. Once a fund passes that, and we know for sure that they're very focused on decarbonization and there's no greenwashing involved, then we do the full financial and general diligence that you would expect from a fund manager. And so far, this has resulted in 12 commitments by Carbon Equity, not in this fund, but over the across our platform. Carolina.
Great. So and nice to meet you all. Good morning. When we start full diligence on a fund, our first step is to go through our climate impact analysis. And we really had to develop our own framework for this, as there was no industry standard on how to select venture capital and private equity funds on impact. So what we've done is devise this framework you can see on the slide. So we have 12 key topics, which we further break down into about 40 total items. We score each of these items on a scale of 1 to 5, relative to what we think is the global best practice per point. And that helps our decision on whether a fund is in scope for us and sufficient enough on their potential impact performance. So our framework really goes through the fund itself, their own investment process. We start at their investment strategy, which is their investment mandate, and assess whether it's sufficiently focused on GHG reduction investments. Then we also look at the team, the organization, whether they have the expertise and the ability to select high quality impact investments within climate. And I think most importantly, we go through their investment selection process. So do they have the right sourcing strategies to find high quality impact investments? And do they do the right analysis pre-investment, meaning do they quantify and assess the potential impact of a solution before they make an investment decision? And also we like to ask questions around how they decide whether an amount of impact is enough for their fund. After that, on the post-investment process, we look at how the funds monitor and report on impact. So this is really our check on the processes the funds have in place. And after that, we also analyze each of the specific technologies that a fund has invested in. So we've also devised our own framework for this. And essentially what we do is we look at all the investments the fund manager has made in prior funds and also the investments they have made in the current fund. And for each of those, we assess whether we think the company will make a substantial contribution to net zero emissions. So how do we do that? Well, we have some climate taxonomies that we look towards. So there's organizations like the IPCC, the IEA, or even the EU taxonomy that have devised taxonomies, or essentially a list of what they believe are technologies we need for net zero. So we first cross-check with those, whether the technology we're assessing is in those lists. If so, then we look at whether that technology has a sufficient reduction in greenhouse gas emissions compared to the technologies we use today. So basically whether the percentage reduction is enough. Is it 10% reduction, or is it really 80, 90% enough for us to get to net zero? Finally, once we've checked that, we also assess whether it creates what we call a lock-in risk. So for example, a solution that could only reduce emissions by 10% could put us in a position where at a later stage of the transition, we then can't move on to lower carbon alternatives. So we would like to prevent those lock-in risks. Sometimes we're assessing what we call breakthrough technologies that are not yet part of lists by these leading climate institutions. And then we would also do a bit of a market analysis on the size of the problem, essentially. So we set a threshold for ourselves of 50 megatons of CO2 emissions per year. That's kind of what we consider a big enough climate problem. That would be about 0.1% of global emissions per year, because the world emits about 50 to 60 gigatons of CO2. So we believe if a technology is addressing a big enough problem, then it could make a substantial contribution to net zero emissions. And after we've cleared our climate impact diligence, then we move on to the full commercial and financial diligence.
Almost going there, Cara, but we got a good question from the audience, which is, how do you assess decarbonization potential of software companies? And I think it's a great question. Do you want to cover it? Shall I?
Yeah, that's perfect. So we call those enabling technologies, essentially. So software or service technologies that don't directly create emissions reductions, but that can support. So we would actually do it in the same way. So we are not looking at whether that technology won't be probably one of these lists of net zero technologies, but it will support one of those. So then that's what the difference, I guess the main difference we would look at.
Great. And we got another question, which is, could you share an example of a lock-in risk?
Yeah, absolutely. So that's kind of a technology that is that gets us kind of partially to the way to net zero, but not the entire way through. So I'm trying to think of something, maybe like, one that we tend to use is, let's say, feed additives for cows. So a big emissions problem in agriculture is, well, the cows produce methane emissions when they eat or burp, and ways to, let's say, take cattle out of our lives is to have meat alternatives, for example. But some companies are working to give feed additives to cows that will reduce the amount of methane they emit. But this is usually not, let's say, a substantial reduction. It's probably around more the 30% range. So essentially, we are reducing the emissions of the problem, but not enough that it would actually get us to net zero. So it's not a solution we can rely on for keeping global warming well below 2 degrees. And if, let's say, the entire economy would switch to this feed additive, then maybe at some point, cattle farmers won't be able to fully transition out of cattle farming, let's say, to put it that way.
Great answer. Maybe just to add to that, so with lock-in risk, it's always a bit of a balance, because you do want to also use those technologies that can reduce emissions now, even if they don't get us all the way to net zero, but you don't want to create problems in the future. And so typically what we look at is you don't want to do big CapEx investments in things that are not net zero aligned, or really big even research investments. So another example would be, what have we seen? For example, machines that can print concrete, but they use regular concrete instead of low carbon concrete. So then you're actually building big machineries that can help you reduce 5% of concrete usage because you have less waste, but it doesn't put you on the trajectory for innovative technologies. All right, over to Wiebe for our general due diligence.
Yeah, so once funds indeed pass our very strict impact diligence and criteria, we still do a ton of work on the more general topics, I would say. So especially on team and organization, that is key. We do come across a lot of funds that are first-time funds or emerging managers who haven't worked very long together as a team. And historically, that has been a reason why a lot of funds have underperformed, because people would fall out with each other, teams would fall apart. So for us, it's very important to understand who we are dealing with and how they have been working together and what they have done in the past. So what are their track records at prior firms? How much investment experience do they have? Have they invested through the cycle? Have they dealt with adverse macroeconomic conditions? Those things are all very important, and we try to select the teams that have proven expertise and abilities to maneuver in these settings. But also from an organization point of view, are all the processes institutionalized? Are there other LPs, highly institutional LPs, who have done their full work and got comfortable with them? That's also important, an important checkpoint for us, whether or not a firm is investable from that point of view. But also we dive deep into the investment strategy. How thoughtful are they? Is their sourcing strategy? Do they have the right network to execute on their strategy? A network of venture partners, operating partners, or just informal people who are helping them out. That's all extremely important as well. And we do a lot of checks with CEOs just to understand, why did they work with them? Did they live up to what they promised they would do? Reference calls with other GPs. How do they look at these teams? Do they want to work with them and co-invest with them in the future? That's also a very important aspect of our diligence. And then finally, the fund terms. Obviously, we want to negotiate the best terms for our investors as well. So it's an important aspect of our general diligence.
And Wiebe, there's a question specifically for you. So Casper writes, "Hi Wiebe, for the selection process, I like to focus on the top 5% funds only, but how do you select that top 5%? Because I assume that the track records are still limited. So how do you define top decile performance?"
Yeah, and so we will introduce at One Ventures, for example, one of the first funds we have selected. I think that's a good example, right? So it's a team. Let's go there, by the way. It's a good way to move to at One Ventures. So this team started investing together in 2020. So indeed, like Casper says, it's young. It's a young organization that has only been together for 3 years. And they started deploying Fund 1, really trying to tackle hard to decarbonize sectors. So breakthrough technologies, exciting. But their Fund 1 is off to a phenomenal start. Not only from an impact point of view, we're excited about the companies that are in there, but also financially, and really driven by follow-on rounds. So this is not the GP itself that marks its portfolio up. No, this is by other market participants who have invested into that portfolio. So 2.3 times after 3 years, that is a very strong portfolio, a very strong performance, I would say. So I would be pleased if all the funds after 3 years are at a 2.3x. So there, yeah, that gives us a lot of comfort, right? I mean, they are able to pick the best funds. I think the firm is founded by Tom Chi. Just to give you an example why we're comfortable and very pleased to be investing with them. Tom Chi is a highly experienced prototype developer, and that's what he's done at Google, at Microsoft, and Yahoo. So he was one of the founding members of Google X, where he worked on Google Glass and the self-driving cars. But really, prototyping is what he has been doing, and he is such a huge support to CEOs who want to prototype and develop their product and ultimately scale their product, because that's what he has been doing for decades. So he brings a ton of experience, a great network, and he has brought in also two great partners, Laurie and Helen, who bring either deep tech experience and financial backgrounds. So the three of them, I think if you look at the portfolio, especially in Fund 1, that really excites us was Noon Energy, low cost, ultra, a long storage, energy storage solution. So great company, but also Gradient, a highly efficient HVAC company, low emission HVAC company. And Ascent Elements, that's a lithium-ion battery recycling and manufacturing company. Those are all doing phenomenally well. So that's what we're looking for: traction in the portfolio, an experienced team, yeah, it's true that there are no realizations yet. So it's early. It's not fund number 10, and they have had 6 funds that are fully realized. You won't find those opportunities in climate. So you're looking really for traction in the portfolio, build conviction on the new investments, and we'll go through one of the examples from that portfolio, and the financial performance of the funds. So hopefully that answers the question. So how we try to build conviction and pick the best funds out there.
Thanks, Wiebe. So yeah, just sharing one example of the portfolio from the new @One fund, so the fund that we've committed to. They've done 8 investments so far. For us, it really all comes to life when we talk about these examples, so happy to share them with you. GigaBlue is a carbon removal company, so they take CO2 out of the sky and lock it in for 1,000 years. But they don't do it with high technology or technologically like direct air capture, but they do it using organic molecules. Now let's just step back a little bit. So carbon removal, we really need it. Take any scenario from the IPCC on getting to net zero, and they say we need at least 5 gigatons, maybe 10 gigatons of carbon removal by 2050. That's about 10 to 20% of all emissions that we create today. So it's going to be a massive market because right now we're in thousands of tons of removal, so only a tiny fraction of that. And GigaBlue is using oceans to do that, and it's really one of the lowest cost, highest potential trajectories that we have. And what they do is they make microparticles made mostly out of wood and disperse them in the ocean. And with that, they're actually recreating a natural process called the carbon conveyor belt. So back in today, before we kind of industrialized the world, trees would fall down, they would fall into oceans, they would wash out onto sea, and in the sea, those trees or branches or whatever were actually great places for algae to grow. And they would feed happily on that carbon from that tree, eat it, and at some point sink to the bottom of the ocean and stay there for a very long time. That process mostly ended because we clean up our rivers and trees don't fall in anymore. Mostly also because we cut down a lot of forests, but now we're recreating that process. So they make tiny microparticles made from mostly wood, and they disperse them along shipping routes. So ships actually take them with them, and in the right places, they disperse them. Then microalgae, mostly phytoplankton, and you see a few of what they can look like on the slide, eat those particles and actually attach to those little particles, and they keep eating at it and growing from them until they get so heavy that they sink, which happens after approximately 15 days. And if they sink to more than 1,000 meters in depth, that's where really actually nothing lives and nothing really happens. So it's a very stable place for carbon to stay. They are creating the right instruments to really measure that actually remains the case over time, but a lot of research has backed it up. And so that's how we remove carbon from the sky into the ocean. They think they can get to a gigaton, so that's about 1/5 to 1/10 of what we need. So it's a massive solution. We're very excited about it. And then on to a second example, or at least the second fund that we've selected for the fund.
Yeah, so the second fund is Extantia Capital, their fund 2. So Extantia Capital is also a young organization based in Berlin. They started investing together their fund 2 in 2020 as well, similar to One Ventures. So we were also able to see the kinds of investments they made through that fund. And maybe also touch upon the track record question we got. In this case, besides looking at the fund 1, we were also able to look at the partners' individual track records prior to forming Extantia, because 2 or actually 3 of the partners had venture investing experience prior to funding Extantia. That's Yair and Carlos at venture capital firms, and Torben had an extensive angel investing track record. So we could also assess the performance of those investments, which we were quite pleased about prior to making our decision, which helps. Besides that, on the track record side, we're also quite impressed by Extantia's climate impact approach. So they have actually an in-house head of carbon math, who is a professor at Cambridge, on exactly doing forward-looking life cycle assessments on carbon emissions. And they've developed quite a high-quality climate impact approach on how to assess really science-based the decarbonization potential of each technology. And Extantia focus really on early-stage hardware technologies mostly that can address the highest CO2 problems. So I will also introduce one of those. So we will focus today on Riverian, which was actually their first investment out of the second fund. So yeah, Riverian builds these container-sized units, which you see on the slides. And the main thing they do is they can convert biogas to electricity, but they can do much more than that. So yeah, exactly. What they've developed is what they call reversible fuel cell technology. So indeed, the main thing is for, let's say, farmers or industries that have agricultural organic waste, you can have biogas from that, and biogas can be converted to electricity as a greener source of what we call baseload electricity, meaning when we need a more constant supply of electricity, when there's no wind or solar energy, we can use biogas and put that into the grid as electricity. This does emit some carbon due to burning organic waste, but Reverion's units can also capture and store that carbon to make a carbon negative process. The second part of this technology, which is quite interesting actually, is that in moments where there is excess solar or wind energy in the grids, then Reverion can take that electricity out of the grids and essentially become an electrolyzer and either make green hydrogen or green methane with that electricity. The purpose of that is to essentially store energy in a different form for future use. So then if we need it, then the machine turns into the mode I described before and turns that methane or hydrogen into electricity again for the grid.
Great. Thank you, Carolina. So this is an overview of the pipeline of funds that we are in active diligence on. So following the One Ventures 2 and Extantia 2 investments, both are earlier stage investments, we expect that the next one and potentially two investments will be in later stage growth funds. So we have now 4 to 5 funds, growth funds on the short list, and I expect us to make a final decision on which ones will ultimately make it in the next 1 to 2 months. So that's exciting. Great funds out there. More sizable fund sizes, obviously, the growth equity opportunities, so ranging from 500 to 1 billion, mostly globally focused. But there's a lot to choose from, so that's great. So we're excited about many of these. But at the same time, we're still scanning the market, obviously, for earlier stage funds. And some of these are seed funds. So for seed funds, we tend to make smaller commitments. So we right-size the commitment that we make to those funds. It's higher risk, longer duration. So typically the commitments that we make to these funds are a bit smaller, but we do like that exposure as part of the overall portfolio.
And Wiebe, we got another good question from the audience, who I think picked up that we so far committed to 2 funds focused on hardware investing. So the question is, what is our current allocation amongst different types, hardware, software, hybrids? What's our target? And generally, do we see a difference in profitability and risk profile between those types of technologies?
No, those are good questions. I think so what we're trying to, it should be a balanced portfolio in the end, right? So you want all of these technologies because we need it all. We also need digital solutions. So I think in the end, we want it to be more balanced. We will focus on also software-specific funds to balance it out. So it's a good observation that these two are a bit more hardware-focused, but ultimately, I would say 50-50, broadly speaking, between hardware and software and tech-enabled services. I think that's probably a likely outcome. So over time, it will become a bit more software-focused. I think from a profitability point of view, scaling a software business obviously is easier. It takes less time. It's proven software that you can scale software very, very quickly. The really deep tech stuff needs more time to scale, but once it is successful, the market share in the huge markets is much higher. So I think the outbreak potential really sits more in the hardware side, whereas in software, it's easier to replicate. You have many more providers of these solutions. So yes, easier to scale, but the overall outbreak potential is probably more in the deep tech opportunities. And we want both. We need both. So we try to build a portfolio that has exposure to all of these solutions.
Thanks. We got another good question. This might be a good time to answer it, which is, has Carbon Equity changed its fees compared to Fund 1 for Fund 2? Maybe you want to explain a bit there, Wiebe.
So the setup fee is the same. We have introduced more separate buckets depending on how much your commitment size. So a bit more flexibility and a bit more different share classes therefore. But the setup fee is the same, and overall I would say, broadly speaking, it's in line with the prior funds. And also no performance fee. We didn't have carried interest in the prior fund either.
Yeah, so absolutely. The structure stayed the same, a little bit more tiering, also for the higher tickets, more attractive fees for higher tickets. For the smallest ticket bracket, we slightly increased fees from 75 to 85 basis points. And there's the reason that we just feel that that is better right-sized for the work that we do to make all of this happen. So how does it all work? We talked a lot already, but just quickly summarizing. So 1, your capital is bundled with other investors into our fund. And then from that fund, we make multiple bigger commitments to underlying funds. Through that, you get exposure to at least 150 climate technology companies. And we really like to share those stories. So here you see a clip from our portal, where we talk about every single one of those companies. We really explain to you what makes them amazing. And we also track them over time and share the good news with you if there's progress, or less good news if need be. And that portal is fully live. You can access via your phone or your computer and get up to date on the companies, the funds, and everything that's happening in your investments. And we just want to highlight that Carbon Equity, in the end, it's more than just an investment. So we're really building a community where we're sharing webinars, insights, newsletters, blogs, trying to onboard as many people as possible on climate tech and every exciting thing that's happening there. And we also host regular events for all of our customers, climate tech drinks and other sessions to make sure that you can connect with each other. So how does it work from here? We suggest that you book a call with us if you're interested in hearing more. So after this webinar, you'll get an email with the option to do so. And from there, you can request more information if you haven't already, or you can do it directly. Also share this presentation with you so you can access these links. From there, you can request your allocation. It's one final form that you have to fill out. And then you can formally start onboarding. Cool, we still have 8 minutes for Q&A. I'll stop sharing, but very happy to hear if there's anything else we can ask or answer. I see that Jacqueline is also dialed in and is urging you in the chat to ask any question you might still have. So happy to hear them. Well, maybe we can just end on an early note, unless just looking at you, Wiebe, Carolina, is there anything you guys would like to? Oh, I see a question coming in. Do we as GPs, partners of Carbon Equity, also invest in this second fund? It's a very good question.
Yes, of course. Yeah, we invest alongside our investors. Whatever we have available. That's I think the message. We have invested, I think, approximately close to 1% in Fund 1. I think, given that the fund is increasing, I'm not sure if we'll get the full 1% on this fund, but we'll try to get as close as possible. But in the end, it's important that we invest in the same fund as our investors. I find that an important metric myself as well if I invest. So you can expect the same from us.
Yeah, and I can also just personally say that I'm really excited to invest in these funds. So I'm really happy to be part of it. We got a question from Casper. I think Wiebe, you can best take it. So what does the cash flow profile for Fund 2 look like? When do you expect drawdowns? Do you have a view on that already?
Yeah, so we had the first close, and given that we already committed to the first 2 funds that have been investing also for some time, there will be a capital call straight after the second close. So we expect to have a second close early October. So thereafter, we'll have a first capital call. And the first capital call, depending on your commitment size, but for larger commitments, will be 25% of your overall commitment. And then thereafter, it will be a regular cadence depending on how much capital will be drawn from the funds. But I would expect approximately 15% per year will be drawn down. That's our base case for Fund 2, which is the same as for Fund 1. Great.
We got a bit more technical question, but I'm very happy to take it. So what's Carbon Equity's approach to investing in FOAC, so first of a kind projects? Indeed, a lot of the companies that we help get funded make hardware, meaning they do first of a kind projects. They build first factories or sites to test their technologies. So Carbon Equity is exclusively equity investors. So we only invest in the equity of companies and do not do project finance. And companies differ in how they fund these forward projects, these first of a kind projects. So some of them do it with fully equity. They prefer not to, we prefer them not to. We would like them to get some debt funding in there because it's more attractive for all the equity investors. And increasingly, they're also able to. So increasingly, there's also investors that can help there or government grants that can support there. And it's one of the things that we look at when we look at fund managers, which is also how good are they in helping in getting that project finance in. And if it's not for the first fund or the first project, then at least for the second and the third. Anything to add, Wiebe?
No. Good job.
Cool. Then we have another question, which is, what is your vision on investing in companies tackling other SDG challenges, such as access to healthcare? Progression in those areas will also contribute to tackling climate change. The way that we see the big world in which many problems still need to get solved is that we decide to focus on climate change first. So we really believe that the time to act is now for many reasons, but primarily because there's a lot of scary tipping points that are approaching. These are things that if they happen will be very hard to reverse and will further accelerate climate change. So we really think that this is a unique moment to act. And we also think that climate change is actually a predictor of many other things, such as biodiversity loss is the #1 cause. And if you fix climate change, meaning you get climate fix in place, you will also automatically go much more circular. So there's a lot of kind of coherences. And when we talk about health, also limiting climate change will limit exposure of a lot of people to a lot of scary diseases. So there's a lot of other problems in the world, and maybe in the future we'll launch funds that are primarily focused on that. But for now, it's GHG mitigation first. Then, Wiebe, one more for you. What is the fee structure of the underlying funds? And are you able to negotiate better terms for our fund of fund?
Yeah, it varies. I mean, broadly speaking, the larger funds, let's say $1 billion plus, charge between 1.5% to 2% management fees a year, whereas some of the smaller funds start sometimes with 2.25%, and we've seen even 2.5% for some of the funds, which is very high. But that's more on the seed to early stage funds, the smaller funds. On the venture, like the earlier stage funds, we tend to see a cap of fees of 17 to 18%. And in certain cases, we have negotiated a cap into the agreements. And especially in the past 6 months, it's clearly becoming a more of a buyer's market. So we have more leverage than in let's say, beginning of 2022, when there was still a lot of capital available. Right now, it's a much tougher fundraising market, and you can really negotiate these kind of caps into the agreements. So that's obviously what we do. So we don't like these more US style 2.5% fee loads on funds. We're uncomfortable with those. So generally speaking, yes, we are able to negotiate better terms. On the carry side, larger funds, just 20% carried interest, fairly standard, I would say. You do see some of the venture funds that have a super carry of 30% once they have achieved a 3x net return to their LPs. So, and yeah, you still see those sometimes, not often. I think, yeah, 2 and 20 is more common.
Great. We have one final question that came in the chat, and it's about the portfolio companies. So a lot of the companies in which we invest, they probably have synergies amongst them. Do we ever make connections between those companies that could use each other to grow?
You want me to answer that one?
Yeah, I can also do it.
Yeah, sure. No, so far we are an indirect investor, right? So we want to play a role in this community, and especially towards all the fund managers by adopting the best standards on impact reporting. But we're not hands-on involved in managing the portfolios and putting all the companies in touch with each other. Could it change over time? Yeah, if our co-investment program becomes much larger and we're a significant player there, sure, but that's far out. Right now, we're really focused on interacting with all the fund managers.
All right, well, 1 minute at a time. So I think we wrapped. Thank you all so much for joining this webinar. And if you have any further questions, I hope you reach out to either one of us personally or through the email that is coming your way. Thanks a lot, everybody, and have a great day.